Let's get one thing straight. When I say you need to be more active in your investing, I don't mean that you need to day trade. In fact, I strongly recommend avoiding day trading. I don't even mean you need to look at your shares every day or even every week. Active investing means staying engaged with your portfolio and learning how stocks and markets move. So let's get into my example. In this example, I've used the ASIC MoneySmart Compound Interest Calculator. You can visit the website yourself and play with the figures to tailor them to your requirements. Here we started with $500 and added $500 each month for 20 years. We also assumed an average rate of return on your investment of 10%, which is very achievable with a capital gain of roughly 7% on your shares and dividends of 3 to 4%. Your input is $120,000. You gained $262,848 in interest to have a total over 20 years of $383,348. If you got a 15% return, and assuming everything else is equal, your total would be over $750,000. Whilst these sound like big numbers, they are both achievable if you are an active investor. Whilst the example I've just shared is really about how your money can compound over time, and it required you to be active in continually adding $500 to your investments, it was not really about active investing. Being an active investor means being prepared to sell a stock you own that's in profit. It also means selling if it's in a loss. Selling a stock you are losing money on is the hardest thing you will do. But I know that the more you do it, the more money you will make. As investors, we need to protect both our capital and our profit. And to do that, we need to use a process. You see, if you don't make $10, you just don't make $10. But if you lose $10, then your capital needs to make $11 to break even again.